I have with me Santosh Navlani, who's the Chief Operating Officer of ET Money. Thank you so much, Santosh, for taking the time. Good evening to you. Would you agree that this is a complicated thing to choose the right insurance for you, life insurance, I mean, particularly because it has been missold in the past and people don't necessarily understand what it is meant for?
Hey Alex, hi. Yeah, of course. I think it's one of the most probably missold and misbought product also, if I can use that word. Many a times, most of the investors, individuals are, not really open to actually look at insurance as an expense. And everybody believes insurance is an investment, and at least people who believe that insurance is an investment actually get missold a lot into, and they probably also misbuy all these kind of products a lot. Idea is that insurance is for the rainy day. It's for a day where you don't have any other source of income, or you basically are running into a loss and you want to make somebody else make good for it, and you're paying a price for that as an expense towards it. And once we understand the importance of this as a part of financial planning tool, then it becomes probably one of the most simplest product out there in the marketplace. I can probably make this a bit more understandable by comparing the life insurance with general insurance as well. Uh, all of us probably who drive cars, four-wheelers, two-wheelers on Indian roads know that actually having an insurance policy for our two-wheeler or four-wheeler is a must before our car or our two-wheeler gets on the road. And it's basically beneficial for us and not really for the insurer or the government of India who makes this mandatory. When you're stepping out, there is always a risk that something might happen to your vehicle, something may happen to somebody else's vehicle, and you basically are paying an expense on an annual basis, so that if something goes wrong, insurance company foots the bill for your vehicle or somebody else's vehicle. Now, similarly, we have to understand that when the way we don't mind possibly paying for a car insurance premium, we should not also mind paying for life insurance, because what life insurance is, when one gets hurt, one basically to a level that he is no more or she is no more, the insurance companies actually pay a lump sum amount to your family, because ultimately the family breadwinner is responsible for the welfare of the family. And if he or she is no more and he is the sole breadwinner for the family, then the life of the dependent should not be stopped. And when you start looking at this concept and this aspect of life insurance, you would not probably mind the expense that you're paying. And what has happened is because the product, the Indian consumer doesn't really buy this as an expense item, insurance companies have created a lot of variations which actually create confusion in minds of people, and we can discuss all those variations on the show. But in my opinion, it is the simplest product when you don't confuse the objective of it with investment, but actually looking at it as a pure insurance, as an expense item.
So that and the definition of that, speaking of variance, is a pure term plan. But there are various life insurance policies, Santosh, that are sold. So let's look at the various types and then let's drill down into what an individual really needs.
Yeah, so if we can focus today's concept on the show on the term life insurance part of it, where we are discussing multiple variations here. So the simplest term plan, a term life insurance plan, is a plan where you basically are committing to pay an annual premium towards a lump sum amount which your family would get in your absence. So, for example, if a 30-year-old single breadwinner for the family is believing that if he is no more, he or she is no more, his family or her family requires about a crore to ensure that next 10-15 years of their lives are not compromised on lifestyle, on life's important goals like children's education and things like that, before somebody else gets ready to earn the bread for the family, to earn the monies for the monthly expenses for the family. For that duration, that person requires a crore of money to take care of the family. And for a crore, basically a non-smoker, 30-year-old healthy individual can basically expect to get a term cover of 1 crore for about 10,000 rupees annual premium. So that's the simplest thing. You pay 10,000 rupees every year. If something happens to you during the period of say 35 years for your in your life, then the insurance company will actually pay a lump sum amount of 1 crore to your family. And that is the simplest insurance plan, life insurance plan you can buy. But because Indian consumers expect that, what if I don't die in these 35 years? Then my money goes waste. If that mentality that we have as Indian society possibly is motivating a lot of insurance company to introduce variants where at least they create some kind of incentives for people to buy these kind of important products. One of the most important variant, which is quite popular as well, is return of premium term plan, where what happens is, because the biggest problem or the hurdle that we have in our minds is, what if I don't die and I don't my entire 10,000 rupees paid for 35 is going waste? Insurance company creates a plan called return of premium plan, where the premium might actually become double or 2.5x of 10,000 rupees. But what will happen is, if you don't die in 35 years and the end of the policy tenure, your family or you would get the entire money back minus the taxes. So if there's 18% GST on the or 5% GST, sorry, on the policy premium, I guess that gets deducted and rest of the money comes back to you. So if you pay like 20,000 rupees a year as policy premium, then minus the taxes, you get all money back as a lump sum amount. So people have created this kind of policy and it's quite popular in India. People buy it. We personally believe at ET Money that it is not the best way to buy life insurance. You should keep it simple, pay annual premium, and if you are not able to convince yourself to pay the convince yourself to pay a simple premium where you don't get any money back after the policy premium, start an SIP of that extra amount that return of premium is promising you. And the 10,000 rupees, if you invest for 35 years on an SIP, might become 10x in 35 years, and you get much more than your policy premium. So these are the two premium things. Like, there's a normal term plan, and there is return of premium term plan. Are like two modes of buying term insurance cover in the country today.
Yeah, and you've actually mapped that out. You spoke about it a little bit here as well, but just to drive home that point, you're effectively paying on an average double of what you would pay on a regular term plan if you want a return of premium. And if you, like you said, if you invest that supplementary amount every month, you could in fact make much more money. What are the other variants that you should bear in mind, Santosh?
So the other variant, so this is a kind of variant where it's kind of term plans, which is a normal term plan as it should be, and a return of premium term plan. Other way to look at term plans is how you pay for your term plan. So there is something called as regular pay, something called as limited pay, there's something called as single premium play. So we can probably understand all these three payout options. So what happens in regular pay is basically the simplest one, where I pay 10,000 rupees as a 30-year-old for a 1 crore term cover for 35 years of life cover tenure. I pay 10,000 rupees every month is regular pay. Sometimes what happens is people don't like a liability on their heads for 35 years. Like 10,000 rupees for 35 years is a sum which people may not be comfortable to commit themselves. So what insurance companies do is they also allow you to a limited premium term plan, where what happens is, instead of paying for 35 years, you have an option to pay all your premiums in 5 years, 10 years, 15 years, 20 years, and so on and so forth. So you can choose what suits your comfort. And it's sometimes kind of useful for people who are not in a salary job, who probably don't have a predictable source of income. Their incomes actually keep changing every year. Or even for people who actually decide to buy a term plan pretty late in life, say 45 years of age, and they're expecting to retire in next 10 years. They don't want to commit themselves for 35 years because they're not going to earn after 10 years from now. So they like to get the liability of that in 10 years. So only in special situation like these, limited pay term plan should be exercised, because the fact of life is, when you're planning to buy a term plan, you actually plan your current liabilities, and you say that what if something goes wrong tomorrow and I'm no more, is how you plan your insurance. And typically when you actually take a limited pay term plan, then you possibly are paying higher if something happens to you early. Of course, I'm not saying that we should be thinking like that, but the fact is, by paying higher monies right now, you actually are losing the compounding that you can use the money for something else. So if you are, unless you are somebody who is like about to retire faster, or you are not having a petrol source of income, I would recommend stick to regular pay kind of premium plans, where you just commit to a month, kind of annual monthly premiums as you decide to do so. There is we can discuss another aspect of insurance plans, where there is also an option of what kind of payout option you can still select for your
In just a bit.
nominee or your
Santosh,
family,
I
so
will
that
come to that in just a bit, but before we do, there are a few other aspects to cover because insurance companies tend to give you a few kickers or options depending on what you want to add on to a product. So, for example, there is a child education cover that you can have, there is a joint life cover where you can add your spouse onto the policy that you have. There is also an increasing sum assured. There are a few other options, right, where you're talking about a built-in permanent disability or accident insurance or critical illness. And finally, there's also the whole life term insurance, which covers you for a protracted period of time. What would you say about getting these kickers?
Yeah, so the simpler answer is basically keep it simple, but let's kind of delve into each of these options. So sometimes insurance companies have a kicker in terms of covering your child education as a financial goal for yourself. So they'll give you a lump sum amount because you chose to opt for it, but they'll also pay separately for your children's education. And it becomes unnecessary variant, in my opinion. What you instead can do is go for a higher cover directly. It may be cheaper for you to do that. So if an insurance company is giving an option that for a child insurance kicker or a extra rider, they're giving you 50 lakh rupees extra, and you're buying 1 crore for yourself, instead of going buy a 1.5 crore for yourself, instead of kind of dividing like these two. Sometimes insurance companies also pay you accidental death cover separately, and I just look at in a real life manner, a loss of life is a loss of life. Just because the death happens to an extent, or that happens through regular course of life, doesn't mean that the family is expecting higher sum assured for those kind of stuff. So I would basically say that go and cut down all these noises and avoid unnecessary riders. There are sometimes a kind of a good rider to have, where what happens is you can actually ask the insurance company to forego your premiums if you basically kind of end up with an accident and you lose your kind of capability to earn income for yourself in terms of disability or something else, where you're no more employable. I think sometimes if you believe that it is good for you because kind of job, your kind of occupation where you have risk of suffering some kind of accident, where you may be kind of becoming disabled to work and things like that, over there you may go and opt for those kind of cover. Otherwise, and even like critical illness covers, or we talked about one more, I don't able to recollect right now, are possibly frills that you can look at. I would rather say that go and opt for a higher term cover for yourself, instead of actually trying to create all these extra riders which may kind of make it expensive for you to get cover, instead of making it cheaper.
Okay. So,
I can also kind of talk about the whole life cover you asked, I guess. The whole life
yeah.
cover is basically where somebody's opting to kind of have a very long tenure of your life getting covered. Like instead of 35 years, you basically opt for a kind of policy where till the time if you basically die even at the age of 99 or so, your family gets money. And typically people use these kind of policy for legacy planning or inheritance for their families and things like that. If you think about it logically, if you basically have taken care of a family properly, you've ensured that they have a good lifestyle, you've earned enough for yourself, you have taken the care of your child's education goals and things like that. Planning inheritance unnecessarily through insurance becomes an expensive proposition. Instead, you should invest your money, create that wealth, and have that wealth getting transferred to your family upon your demise instead of actually using insurance for that. It becomes an expensive proposition, in my opinion.
Very fair. In fact, life insurance should give you a little bit of lead time while you accumulate the wealth that you will use later in life and also to pass on to your loved ones, to your dependents. Let's talk about the payout then, because this is something that you were starting to talk about, but I wanted to give it enough time, Santosh, because it's important to talk about this as well. It's not necessary to have a lump sum that comes to your dependents. You can choose to have it in a staggered manner. What can you tell us about that?
Yeah, so there are a couple of variations here, and they're interesting variations to look after. Is about how you. So basically, it's about planning yourself, how your family would get the money upon your demise when you're no more there. So one is a lump sum, like you opt for a 1 crore term cover. Your family gets 1 crore at one go, and if you are somebody who believes your family may not be able to handle that large sum of money and may not be able to invest it or park in a safer asset class where they can actually withdraw their monthly expenses from, or you have a setup where you believe that you are better off, your family should not be getting this kind of money at one go, and you believe that they should be getting a monthly expense the way you earn your monthly income today. So you can instruct insurance company that pay lump sum amount as need be, or opt for a monthly payout where just like you earn monthly salary, the insurance company sends you monthly expenses in your bank account as a nominee's bank account on a monthly basis. And there are variations here as well where you can opt to actually increase the monthly payout annually by 5% or 10% depending on inflation. So that's an interesting way where you don't have to worry about basically the cost of living going up. Will that be able to make up, your family will be able to afford it if you choose monthly payout or not? So these are interesting variations, and you can choose to opt for it or not opt for it depending on life situation or your family situation, and the nominees financial understanding and capability to take investment calls and things like that. There's third variation which actually has a combination of both, where you can say that I want lump sum and a monthly both, because sometimes you have a home loan and you're probably taking a large cover of say 2 crore or 3 crore to cover your home loan liability as well as your life expenses that your family requires. So insurance company also allow you to have an option where what portion that you would opt for at a lump sum and what portion you would want to have on a monthly basis. So these are good variations to keep in mind depending upon your family, depending on nominees capability to manage finances, is how I would put it.
Absolutely. And the bottom line, of course, is that you should keep it simple. And when you keep it simple, you can make what is usually a complicated decision into a very simple one. Thank you so much, Santosh, for taking the time.
Thanks, Alex.